Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. Got Claude and Andrew here. This might actually be our last episode for a little while. There's a few different overlapping traveling schedules for the next few weeks, but yeah, we'll jump into it. So good news. I think that, I don't know, there's a lot going on in AI, so I kind of dug in. We talked about it a bit last week. I think it had just dropped as we were recording, but the new ChatGPT, I've been pretty impressed with it. I guess the other one for me was Google's rolling out AI generated summarized search results. I think that's, another bit of progress, but also just pretty interesting because I think it kind of disrupts the whole way the internet runs at the moment, where everyone kind of works hard to get a high Google ranking, and Google kind of moving to directly answer those, or other AI engines answering them directly means that all the traffic that's currently going to those news websites and other stuff potentially just doesn't even go there anymore. Like they're just trained on them and doesn't even answer them. But yeah, pretty interesting development. Did you guys have any thoughts on that or any other developments that caught your eye over the past week?
I mean, it's definitely the topic you can't get away from. You know what I mean? Like it feels as though we talk about it a lot because we do, and you kind of think, oh, that's really cool. We make some comments, there's new progress. And then a week later, another groundbreaking development. So yeah, it's hard to keep up with. And it's very hard, look at it through the investing lens. I'm finding it really diabolically hard to sort of extrapolate these trends and know what it means, other than it's going to be a big deal. Usually what happens with a lot of these kinds of things is that they kind of change the world, but in ways that are unexpected. So I don't know what to do with it. And I guess it may be keen on your guys' thoughts. Another lesson here, from history with new technologies, is that it's often not the first significant player in the space that necessarily does well. And it can often be beneficial to sort of wait until a clear winner emerges and then go all in. Very concentrated. This is sort of like the lesson from the Guerrilla Game book, right? And what's so hard about that is the psychological side of it, because at that point, you'll be looking at share prices that have gone up 5x, and then you're going all in, right? And it's very difficult to do. But again, taking the lessons from history, if they really are the ones that are going to exploit this technology the best, it can still run a long way for a long time. So I don't know. At this stage, I'm very just fascinated and watching. It's not really changing anything I'm doing on the investing front, though.
Yeah. I found GPT 4.0, which is terribly named in my opinion, but 4.0, letter O. I found it it definitely is a step up for me. And I keep going through these phases. Claude kind of touched on it last week of you use it and you're blown away, and then you don't really keep using it. But then I kind of come back to it and oh wow, this is crazy good again. And so yeah, I think it's just a habit thing. We're probably just at that point where it's does it once you integrate it into your process. And it could be the case that business kind of leads it, because business integrates in the process and keeps going for a while until we have a really friendly, easy to use consumer one. And it's just those little friction points as a consumer that make the difference. When you've got so many years of using Google or other ways to do something, it takes a bit of friction to go, actually, I'm going to look on Perplexity or ask ChatGPT this. But yeah, I'm using it for writing at the moment, not writing the stuff, but as a writing assistant. So I'll be a book I've read, I'll be pull out all the quotes and page numbers relevant to this from this book, and it'll give you it. It gives you the page numbers and the reference. Wow, okay, that's extremely helpful. Yeah, so a lot of stuff like that, I found it indispensable now. You just need to decide how much to use it for.
Did you hear I haven't looked into it. I woke up this morning and was scrolling through Twitter, and I think that I think maybe we touched on this, but they're sounding very human now. So it's putting in pauses and stuff. And one of the models sounds exactly like Scarlett Johansson from her. And
I've mentioned this 6 weeks ago on the podcast.
Yeah, I was just they pulled it though last night, I think.
Oh, so, they got rid of it.
They got rid of it and sort of said,
no.
As I understand it. So it's sort of it's kind of
because she kicked up a thing.
I don't know, other than
I did think that's why, Matt, because actually it turns out they'd asked her to use her likeness and she said no, and then they just did anyway.
I think that's a miss from Scarlett. That's a kind of way to immortalize yourself, right?
I mean, they should have paid her.
that is true. Yeah.
I don't know how much they offered, but yeah, that's interesting. Because it was exactly like Scarlet. It was like, that's what I've been joking with friends. It's basically just the movie Her. Yeah. Oh, that's interesting. I wonder what the new one will sound like. Wonder if they get any other celebrity voices.
I'm going to go.
That's a tough one to beat.
It's so hard. Although Hal from 2001 would be up there. I'd be tempted to go with that, just to
really
sort of
keep
you on the edge of your.
Well, you know, I guess.
I think with Scarlet you'll just be too
dangerous.
Yeah, it's just too alluring.
Yeah.
You know, whereas like you need something that's got a hint of evilness to it, just to keep you on the edge of. You know, make just keep you alert.
That's probably a good idea. Actually, it's probably the appropriate distance.
Yeah.
But yeah, the Scarlet voice thing is it's weird, the inflections and stuff. It's like talking to, like, as I'd said before, like a super helpful like nanny or something. Because I was using it mostly for, you know, chatting to the kids or answering kids' questions and things.
So the other thing that was interesting with 4.0 is that the response time is super quick. So in the past you sort of ask it and then, you know, there's it's doing all this magic behind the scenes. So it's kind of like, oh my God, it takes 5 seconds to respond.
Yeah. That's all the
ridiculous
friction, right?
is this? Yeah. Like it's so funny how we are so intolerant. Like there is literal miracles sort of happening here. It's like, but I had to wait 8 seconds for this like silicon brain to tell me stuff. But what was interesting, there was this guy who seemed to know what he was talking about, and it was just like his theory was they're putting a lot of human speech mannerisms in there at the beginning to give it time to think. So there's two models. There's the model that responds straight away, and while that's responding, the other more advanced model is coming up with the more robust, intelligent answer. So when it first answers, it'll go, yes, that's really interesting, and those words are inserted. That's just one example, but when you think about it, there's a lot of
time.
It's buying time, but you feel as though, wow, it responded straight away. It's like, but that initial response, there's not a lot of thinking that's required there.
That's
cool though, right?
I do as well, yeah.
Yeah.
That's what you do when you're on Osbers or something.
That's a good question.
That's an excellent question. I think that, you know, investing is long-term. All right.
Got it.
I've got some good news as well. It's actually about an old technology that's getting used more and more. The bicycle. I don't know if you guys have heard.
What's this bicycle thing you speak of?
I don't know if you guys have heard, so I'm excited. I'm going to be visiting Paris for a few days soon. And I haven't been there since they massively expanded the bike lanes and stuff. But for what I was reading about, it's cycling is doubled or tripled in the last few years. So it's much more bike friendly and less, fewer cars, less traffic. At least certain parts of the city now are very easy to get around on bikes. You can hire bikes and stuff easily. So hopefully looking forward to riding around there a little bit rather than always catching the metro, which is how I used to do it all the time. Yeah, I think that's a really positive thing. There's this sort of Vision Zero kind of movement around the world which aims to cut back on car crashes, and that's tied up into some other sort of movements around basically taking centers of towns, villages and cities and trying to make them less about the car. So, the kind of pedestrian areas where bikes or pedestrians are favored, even if cars are still allowed, they might be restricted to just one lane, and taking away parking, counterintuitively improves business in an area, because you take away that parking, there are fewer cars, it becomes more walkable, people want to hang out there, you start having more pedestrians come into shops. And actually bikes and public transport are a much more efficient way of getting people into a central area. And if you think about it, all the beautiful old centers of towns and cities that we see in Europe and that we really like, they were all designed, the layout of those places were all designed before the car was dominant. So they're really intuitively sized for just, pedestrians or smaller vehicles. So I think that makes for nicer cities to live in. Obviously living in Canberra, it's super car dependent in its huge, ridiculous layout. But at least they make that a little bit better by having good bike lanes around. And it's a pretty joyful way to get around, cycling through the trees or whatever. So just that movement, I think that was my good news, is the good news is I think there's finally some societal pushback against just everything being about the car. Obviously not in America, they're real wedded to that. They don't like bikes there.
Yeah, it's hard if the city grew before the car. Paris began before cars, right? So everything's really close and people used to walk. So bicycles work really well. I used to live in Copenhagen, which is amazing for bicycles. Everyone rides a bicycle everywhere. People push their kids in multi bicycles, delivery men use bicycles. And the funny thing was, you watch a video from like the 1930s and it's exactly the same. Like the clothes have changed a bit, but it's exactly the same. People were riding bicycles then. But then I guess if you like in America, even a lot of Australian cities, like if you're trying to cycle between places, you're screwed. You need to kind of build everything really densely as well, I guess, eh? But I mean, CBD, you could do it to an extent, as long as you have some drop-off area.
I used to ride, back in the day when I lived in Bronte, but like that, you needed an electric bike for that.
Oh man, Bronte is not a bike riding friendly place.
So you can't
Narrow
do it
roads
without
too.
electric bike. It's not safe though. It's scary.
Exactly. When I first moved to Sydney from Denmark, I was like, I'm going to ride a bike everywhere. And it was super hilly. And also just like, people there's no bike lane. Like Copenhagen have raised bike lanes. It's just like constantly almost getting hit by a car. And people just are angry at you, right? No one's like sympathetic to the cyclist.
Yeah. Well, that's what Vision Zero is like. You got to have the separated bike lanes. And it's like also, it's good for like that. People aren't going to take their kids on a bike ride somewhere to get somewhere if they're not safe,
Yeah. You got to have separated, like proper concrete barrier raised bike lanes. That's the way to do it.
Yeah, exactly. There has to be like some punishment for the car if it strays into the bike lane, even if there's no cyclist there, basically.
Yeah, very good. All right, what's happening, guys? What's catching your eye? We had a few things, updates, earnings season, not quite earnings season, but trading updates, confession season-ish.
It's not so much results, but we had a chat with Jason Dixon from the environmental group. EGL is the code. We've spoken to him a couple times now. It's one of those businesses.
I feel like there's been a lot of buzz about this one over the last few years, but can you just start us off by telling us what they do? Like, how do they make money?
Yeah, so notionally it's an engineering services kind of, not engineering service, an engineering kind of business that sort of, it's got its fingers in a variety of different pies. So it's got and operates under different brands. So it'll make gas turbines, mufflers for that. It'll do boilers, air pollution control. They've got some technology to clean up PFAS, contaminants, and it's a business. It's actually 100 years old. Parts of the business has been around forever. And Jason started about 3 years ago. And what's been impressive there, he's been very consistent in his messaging, and he's very much driven some really good growth, particularly at the bottom line. And so when I introduced him yesterday and sort of said that, it's an engineering business. He goes, well, actually, technically, yes. And it says it on the website, but not really. He says, we're actually transitioning more to a maintenance and services businesses in a lot of ways now. 50% of the revenue is recurring, and much better margin through that kind of stuff as well. But they've got some really nice tailwinds, be that sort of regulatory or increasing sort of requirements to sort of clean up businesses to clean up their acts. They are the largest player in many of the segments that they operate. And the thing that really made me pay attention is that a lot of the growth that he has engineered has been done with, he said, without 1 red cent of capital investment, which is just sort of like, well, that is really cool. So just like signing up other partners, they've got some deals with Termac, Cadent, Fulton, announced very recently. In fact, you'll see that as the most recent sort of announcement. And he really hit that a couple of times, saying, I don't think people realize how significant this is for us. And he's more excited now with the growth that's ahead than what's been delivered over the last 3 years, which, as I said, has been very impressive. So he's sort of delivered this sort of top line growth, but at the bottom line, it's been growing even faster. And he just sort of made the comment as well. It's like, I'm not really interested in revenue growth. I want profit growth, which was very interesting. Anyway, so I'm just sort of like just verbal diarrhea at this point. Have you guys looked at it at all?
I have looked at it. I think that the only and look, to be fair, I think this is probably the weakest way you can sort of kill an idea. Don't make things seem like it's a big problem. But for me, I think the issue that I've always had with it, and I've looked at it before, even when it was at lower prices, and I've just thought, I don't get the valuation for the type of business it is. Like now, I have to admit, this is only, I guess, using heuristics to make a judgment. But, using heuristics, I imagine this is a reasonably capital-intensive business. And I also imagine that a fair bit of growth over the last few years has come from, acquisitions. Because of that, I guess I come and I look at the profit, which I guess was around 2 million in the last half. And then just thumbsuck, and this could be wrong, correct me if I'm making wrong on this kind of assumption. But if we just take that, the earnings per share of, about 5.6 cents per share, and which is a bit, let's say it's going to make 1.2 cents earnings per share for the full year, which is a little bit more in the second half than the first half, then that gets you to P/E ratio for FY 2024 of 23-24. And now, I'm not saying that's outrageous, by the way, but and perhaps I've categorized it incorrectly, but I kind of see this business as like a little bit similar, say, to example, to a company that I have quite liked that has a similar-ish kind of thesis, which is SRG Global. Now, I don't own SRG Global anymore because I chickened out, but that is a company that is similar in the sense that it is like engineering services, construction services, but also now I think even more than 50% of its business is kind of recurring maintenance style revenue. And SRG Global trades on a PE ratio of around 15.5. That's historical PE. And admittedly, it's like not the highest growth stock and also growing by acquisition as much as like, more so than organic, but also a dividend yield of 4.5%. These are trailing numbers. So look, I actually chickened out of SIG Global, having sort of bought it previously, but I still see that as, I guess, I would look at EGL and I'd be like, but maybe this other cheaper one that has a kind of similar thesis is more attractive to me. Have I made like category errors there, like in terms of using the analogy? What are the flaws in that kind of analogy if I compared the two?
No, it's reasonable. I mean, I guess I don't know how well the acquisition that comes to mind is with Airtight, moving in more into the air pollution areas. Jason was very clear on this. A couple of times we've spoken to him about it's not growth for growth's sakes. These are very complementary. They at a high level, it sort of looks like, well, you're in all of these different areas. You're trying to be the everything man to environmental solutions. But he really sort of tried to enunciate that no, actually these are all kind of related. And if people come to us for requirements under one sort of banner, we can usually help them in a lot of other different areas as well. Now, this acquisition of Airtight from memory was like $5 million upfront, accretive 15% earnings basis in year one, before any synergies, et cetera, et cetera. I don't view it as any kind of significant acquisition-led growth, but rather strategic acquisition where needed. Balance sheet is super clean. Jason himself is, I think, the largest individual shareholder, or certainly up there, and very significantly so. So it's and it is growing at 50% or 45%. They're on track for. They did that in the half, and they'll do that in the full year. That's what they're expecting to do in terms of their operating profit growth, with more potential for a bit of margin expansion there as well. So you've just got a bit of a business that was, I think, all of those things that you said, Claude, like very much capital intensive, a little bit all over the shop, not run with the most, the highest degree of operational efficiency. And he's basically come in and said, well, actually, we're not exploiting our IP to the maximum capacity that we can here. We want to move away from the CapEx heavy kind of stuff. We've got we touched on this before. We were talking about, what is it, Michael Porter's, like, what is strategy idea of identifying what is it that we do better than everyone else. And I think he's really taken that view with the business and like, this is what we're good at. This is not what we're good at. And they're doubling down on that kind of stuff. I might be counting chickens before they hatch, but during his tenure, I take note when there is consistency of messaging and delivery on early expectations. That is something that I take note of. And then when you start questioning these people about sort of their philosophy around how you deliver growth, what matters in a business, all of this kind of stuff. He said all of the right things for me, and really seemed to understand what it is that's going to drive shareholder returns. So yeah.
I think you touched on addressed some of the things that I asked in that, like, for example, the balance sheet, that's a differentiating factor versus SIG, which I said before, which would make sense why it's on a high PE ratio then. On top of that, the fairly aligned, the management aligned, the CEO alignment, I would put that as a tick in its favor as well. And I just had a quick look at that. And it looks like that the Jason Dixon is it like one of the largest shareholders in the company?
I think 20 million shares or something. He's a very significant shareholder.
Yeah, I'm just trying to get the top.
And you know what? This is nice too. It's $100 million. It's $100 million market cap company. He pays, I think his base is $270K.
Yeah, right.
That's pretty cool, right?
Yeah, that's nice. Refreshing.
It is refreshing. It is very refreshing.
Yeah. So it also looks like he's like the 5th largest holder or something like that, with like 5% of the company. So I'd say that's like better alignment than you mostly see.
Yeah, no names mentioned, but he doesn't seem to be buying $25,000 racing bikes as other microcap CEOs featured in the IFR.
Who is that?
Have been.
The Pointera thing.
Yeah. Yeah. Oh dear.
Okay, cool. No, I reckon I need to take another look at it. Thanks, mate.
Yeah, it's interesting too. I mean, there's the regulatory drive is on a few fronts is very interesting. We've been shipping our recycling overseas for the longest time, and that is coming to an end now. We are ramping up those facilities here at home. And that's going to be an incredible source of growth for them, I believe. There is a lot of PFAS material accumulating in waste treatment plants for water that has to be dealt with. So these sewage processing plants is a name. Anyway, they used to sort of sell the sludge and slurry as fertilizer and stuff. They can't do it now. There's too much contaminants in it. So they had this asset that's now become a liability. And there's just, what do you do with it? So there's just a number of sort of structural industry tailwinds I feel that are there, and they're very well placed to prosecute them with someone who's looking to do it in a way that maximizes profit growth and not just revenue growth or anything like that.
Yeah, nice.
Yeah, so it's interesting.
Very cool. Claude, anything caught your eye?
Sure. So, thought since it reported just this morning as we are recording this, I might touch on a little, I guess, you'd think of it as a medical device company called Aroa.
Aroa Biosurgery.
Yeah, that's right. And so its products are, and this is a mouthful, so I beg your pardon. For example, one of its biggest products is the Myriad range of products, which is an engineered extracellular matrix for soft tissue repair, reinforcement, and complex wounds, being specifically designed to help maximize tissue repair while providing versatility and adaptability across a wide range of surgical applications.
Sounds a bit like Polynovo's.
It does, doesn't it? And also not even miles different from, I guess, what is it, like Avita with its spray-on skin or whatever?
Yeah, true.
Obviously, slightly different use cases. And so it's weird that there's so many in this exact space. I guess maybe it's a little bit easier to get these devices kind of approved than a new medicine or whatever, which is maybe why so much goes into it.
Yeah, and I think once one is approved, you just need to show it's not worse than those in terms of damage. That's often the case anyway, once something's approved.
Yeah, so they have a bunch of different products in this sort of same family. On the call this morning, they seem to be talking mostly about their Myriad Matrix. There's a Myriad Morsels version, which I think is for more complex kind of wounds. Perhaps I think that's more like a powder that they put on it, or not a powder, but almost a powder it looks like. Whereas the Matrix is, like a sheet of paper kind of thing. Then they have another one called Symphony as well, which I think is smaller, but they're expecting to grow that. Either way, they're all these cellular and tissue repair products. Obviously, I'm not a doctor or any kind of expert that can actually fully get my head around which one's better and which one's going to win. But, in the year that they've just reported, because they're a New Zealand company that reports to March, they grew revenue from product sales by about 12%. So probably not the fastest kind of growth you'd want for a loss-making company, which, then lost 10.6 million in the year. So that is kind of very disappointing, obviously, and something does not compute. I don't think it just based on the comments on the call, it hasn't really resonated with the management, how, someone asked them directly, why do you think the share price is so bad or whatever? And they literally were oh, it's just market conditions or whatever. But it's dude, your revenue growth is super low and you're burning heaps of cash. People just don't believe you when they say they're going to be profitable in FY 2025, which they're referring to some kind of EBITDA profit, by the way. Maybe it's even underlying normalized adjusted EBITDA. I have no idea exactly, but it's companies love to talk about how we're going to be profitable next year, but they mean EBITDA. And they didn't even feel confident that they're going to be free cash flow positive because they've got some CapEx teed up for some capacity expansion stuff, and that should finish in the first half. I think they said something on the call possibly free cash flow positive in the fourth quarter. So still pretty obvious, in my opinion, why their share price is plumbing new lows, and pretty concerning that the company doesn't seem to have a firm understanding of that. So yeah, overall, I think that what makes it interesting is that their result was impacted by they have this distributor Telebio, and the reason that their revenue was low, basically lower than expected, was because due to inventory management by that TeleOne. So they said the impact of these measures were confined to H1 FY 2024, as Telebio demand for products realigned with their sales in H2 FY 2024 to deliver a 19% increase in that product line's revenue compared to H1 2024. So basically, a tale of two halves, supposedly stronger in the second half. So that's a believable story. And if they just have a better year this next year, and then they do in the fourth quarter even make free cash flow and get a bit positive, if they do all of these things, then I do think there's potential upside in the company, because absolutely thumb sucking it. They're saying that they can make like maybe $80 million revenue. Obviously, they're absolutely in, and this is New Zealand dollars. This is absolutely growth mode at the moment. But at maturity, you could see that usually these kind of medical devices do have decent profit margins. So it wouldn't be unrealistic to think, this could easily make 10% NPAT margin. That would put you on a over 7 million Australian dollars as profit. And yeah, at the moment, it's 172 million market cap. So, if everything works out, then you've probably got a like pretty darn reasonably priced company that has maybe room to improve margins, that is like, it's growing supposedly, much higher than the rate that they grew this year, which was only 10% due to this destocking issue. So nice little, like, the thesis appears to me, like, doesn't mean I love it, but that's why I think it's interesting. Yeah, overall, over to you guys to hear what you think of that idea.
So I mean, I guess that it had been. It's just interesting. I guess first off, just the slow product growth is just interesting, right? Because you look back a couple of years ago, how fast product growth was, like up into FY23. 22, 23, like, and if you just projected that forward, how much more growth you'd be expecting, and just how these things don't, the real world isn't like a spreadsheet you can just extrapolate like that. So yeah, I think it's just a good reminder of like the dangers of just extrapolating growth, because I think that's part of how it got ahead of itself. Yeah, and then I guess the competitive situation, I don't know, Polynovo is a very similar product, right? Polynovo is more a synthetic alternative, whereas this is using sheep's forestomach linings to create the product. I'm not familiar enough with the differences and advantages, pros and cons, but I guess as you'd mentioned, it's just, I guess understanding the differentiation and like niches for these things would probably be an important part of the thesis, I imagine, because there is a lot of wound care stuff, and I've seen like quite a few IPOs come through in wound care as well.
Yeah, I mean, it's encouraging, something to pay attention to once you get that sales traction. I know, barring the inventory management sort of issue, they're calling 20 to 30% growth in revenue next year. They're losing $3 million at a normalized EBITDA basis, but there's $30 million of cash in the bank. So it doesn't seem as though capital raise is imminent. There seems to be some decent sales momentum, and for me, it's much more interesting now that the share price has come down so far. So you can now get it for close to half of what you could a year ago. I think sometimes you get the market overreacting on both sides. It's going to the moon, and it's $1 a share, and then it's like, oh, this is terrible, it's going to zero, and now it's 50 cents a share. And it's like the truth lies somewhere in between that. And as you said, Claude, there's several ifs in here, and so it's there's no slam dunks, and certainly not with this one. But it doesn't seem as though this is a disaster to my way of thinking.
Yeah, I reckon there's definitely room for a comeback, and then obviously the sentiment has just been down and down and down in the toilet kind of thing, which is understandable, because like the management, like, how could you not be like laser focused on the issue? Like, how could you not have reflected on, hey, why is our share price down 2/3? Like, I think it's because your growth was super low and you're still losing money. So it's like, you definitely need to pick a lane. But I guess their argument is, it's like, it's a one-off slowdown in growth. And then maybe now the market just doesn't believe that. So like, what appeals to me about it is just like, what if there's just this short point where it's like the market's not believing them, but all they have to do is have that growth come back, and then you'll get a 20-30% uplift in the share price just based on that. And then it doesn't really matter if it ends up like finding a good spot in the overall competitive environment that is wound care. What I'm trying to say is it possible to invest in this if you don't do what Matt said, which I think is correct, and a good approach, which is like fully understand it and take a long-term view? Yes, that's, if you're thinking of this as like a long-term addition to your portfolio, for sure. But I guess, the other side of it for me is like, what if it's just a sentiment play? Like, this bad thing's happened due to this thing that was out of their control. That, take a gamble, that doesn't happen 2 years in a row. Revenue growth comes back up, narrative changes, you get some uplift from that. Like, obviously that's a short-term price speculation. So I'm not trying to pretend that like that's a good long-term thesis, but that's what it makes me think of. Like, that's the opportunity is like, is that a thing? I don't know. Zero conviction behind that idea. Just had it as we talked about it, but that would be like the janky little idea that could come out of it for me, because it just seems way too hard to figure out like whether their product's going to be like the winner long term. However, if there are some like awesome surgeons like listening to this exact podcast, I'm sure that we would love an email where you explain to us like which is best out of all of these different options. Like, Polynovo supposedly, rumor has it is a good product and does have some strong growth. So yeah.
And it might not be a case of one or the other either. Like I am guessing, because I'm not a surgeon either, obviously, but I'm sure that there are different use cases. There are pros and cons with any kind of product. And you could probably also say too, maybe if there is one that was demonstrably better, maybe there's a price advantage that you have in another. I don't know, but I mean, what you can say as fact is that a few years ago, they didn't have a product. Now they do. And increasingly, they're selling more and more of it, which is an interesting data point in and of itself. That might evaporate tomorrow, but someone's using it and more of it than they were last year. And by all counts, we'll be using even more of it this current year, 12 months looking forward. So I don't know.
I think we need doctors to weigh in, because like the real question that matters is one of these products clearly better than the other and is going to like win, essentially. Because I remember, back in the early days of researching Pro Medicus, talking to a radiologist and just like verifying stuff like, how long does it take you to download the file to look at remotely? Can you do it remotely? Blah, blah, blah. And when I was explaining to them, that radiologist, what Visage could do, they were basically just didn't believe me. And that was like a point at which I was like, well, either like this company is fully lying about what its products can do, or it's like so much better than what this guy's using that he doesn't believe it exists. And of course, like there was a lot of evidence to suggest they were not lying about what they were doing, in that they had won some big contracts. So that was like a verifiable thing. I think I can get closer, but someone tell us. But like, even Polynovo, like if that is the one that's like just a better product, then it's totally possible that these things can go on winning for quite some time. Like sometimes the better mousetrap thing, like that works. And so I think that's like the bigger question, and I don't know the answer to it for Aroa.
It's usually what keeps me away from companies like this is just that recognition personally that I just can't handicap it. I don't know. Like, I made some comments over the sales traction is one thing, but I'm not a user of the product. You rely on third-party accounts. And within those, I'm sure you could find a surgeon who'll tell you it's the best thing since sliced bread, and you'll find another one equally credentialed who tell you, no, it's rubbish. I prefer this other thing. Like there's a lot of variance in views there, and it's just, I don't know how to handicap it. Again,
it's a good point you make, because like the revenue as like, hey, revenue growth as proof of product superiority is a dicey argument, but it's not a terrible
not superiority, just that there is a market demand for it.
Yeah. No, it's always a good sign, but it's also, you don't know what's generating that demand. Like, I don't know the exact sales process for this. How do they get it? Like, I've definitely heard that, medical products and medical devices, they have quite a sales process. There's relationship building with the customers and the sales reps and all this kind of stuff. And I don't know, so because I don't understand that enough, it's not the same as when you might be looking at like a soft drink, for example, and it's like all very clear, like people are just picking this one up off the shelf. Like they all come to market the exact same way. They're all sitting next to each other on the shelf, and suddenly, Fever Tree's getting all of the people buying it, even though it's more expensive or whatever. And then it's like a pretty easier way to look at sales growth and be like, oh, wow, this is like a more popular product that's taking share.
Yeah.
It's hard. It's more opaque with the medical stuff.
Yeah, it's totally. And the other thing that's hard too is that there's so many examples of where the inferior product has come from a superior business. Domino's pizza, with all due respect, is not great, but it's far more successful than, Papa Joe's around the corner with the old Italian guy who's been making it by hand for the last 30 years and barely making his rent payments,
I have a public service announcement for anybody who may occasionally partake of the Domino's pizza. This is important. This is the most guaranteed win that I'll probably ever give you, right? Whenever you want to buy a Domino's pizza, you have to Google Pizza Hut pizza. And then you'll always get a pretty big discount, like 30-40% off from Domino's.
Wow.
It's the only way to play, ladies and gentlemen.
So you Google Pizza Hut
pizza,
and then you open Domino's, or you Google Domino's afterwards, and you see what is offered.
So it's not all the time, not 24/7, but at most key pizza ordering times. Oh, it worked. So you just Google Pizza Hut pizza, and then for me, I scrolled down, and the bottom Google ad was 50% off Domino's deal. So, but you might have to do it a few times, whatever, like go in incognito browser or whatever, like refresh the ad. It's there. You've pretty much always got a chance for a fat discount.
That's very good.
I make my own dough.
You make your own dough.
Now you do, as the landed... Now that you've joined the ranks of the landed gentry, you're like, I have a pizza oven, my own dough.
It's the easiest thing in the world, like honestly, and it's just there's nothing better than making your own dough. Anyway,
You got a pizza oven there? You got a
no, but I'm going to build
Oh,
one.
okay.
Yeah,
Nice.
for sure.
Very cool. Awesome, guys. We got time for maybe one more, I think. Anything else caught your eye?
Why don't you give us a suggestion, Matt? Have you got one for us?
No, saw TechnologyOne reported this morning, but didn't really have too much on it.
I had a glance.
Yeah, give us your quick take on the TNE results.
Getting it done. Like they are. I think they are one of the better businesses on the ASX. Frankly, I mean, I'm trying to think of a company that has more reliable cash flows given their customer base and what they do. I've always sort of kept away. I think I had some years ago, and I did my usual genius, lock in a small profit along the way. But what's kind of kept me at bay is the valuation. And you that value investor who's just like, oh, I will only pay a P of whatever. It's just dumb thinking that I've done again and again and again.
The value investor voice.
Oh, it's just he's an idiot.
That's what value investors sound like to Andrew.
Just like, I think all investing is value investing. Let me be clear, but I just like sometimes you just get a little bit too, and it's like it's a P of 50, right? But the quality of those earnings, it's just outstanding. And they have, what are they? They're getting 30% return on equity. Their per share earnings growth is a staircase just up and to the right in a beautiful stepwise sort of fashion. I think that they've still got plenty of runway ahead of them. So I really like them. So at a glance, it's just sort of like, yeah, about the same. And another result which just delivers.
Yeah, and strongly integrated. I mean, just government it's a hard customer to get, but once you got it, it's very sticky. And they seem to have crossed that threshold where it's really hard for small companies to break into government because there's so many problems with them. So like random decisions and very lumpy and long sales cycles. But once you're in there and preferred, I think it can be really attractive.
And they're mission critical. That their clients are not going to ring up one year and say, actually, we don't need you anymore. Like even if they did, then now they have to get Oracle or SAP in, and then this is going to be like an 8-year multi-billion-dollar project that's going to end in disaster. It's not going to happen. I mean, you can question how much more they will win and et cetera, but in terms of their existing integrations, they take it to the bank. That's a lock, and they can lift the prices on that at whim. I would suggest there's probably a little bit of sensitivity there, but it's an incredible business.
Yeah, and I think that the way that they approach it is just smart too. Like they're out there way before the tender. They're like almost planting the seeds of the idea of the tender, which is maybe not. I don't know. It's not best for the public. Maybe that's how this thing works, but that's how it works. It's like relationship driven. They kind of setting up the grounds for them to win the tender way before the tender even happens. And that's a long lead time that you have to have, because I think if you're just responding to the tender, you're just in the dark. It's such a hard. I feel for small companies trying to respond to government tenders because they can be it seems so random. Like it's something that it's not driven by like the rationality of business. At least it's it's hard to know what exactly they're looking for. Maybe they just want to get rid of their existing vendor. And there's like a lot more political decision, I guess is what I'd say.
Oh,
and they're like
a disaster to deal with, and then a brilliant client once you got them, right? Like in a lot of ways.
Yeah, very sticky client. Yeah, for sure, and not as price sensitive in some ways. It's an interesting one at the moment too, because the government is like getting rid of all their consultants, and so like they're just trying to build up a lot of domestic, what would you say, in-house competency. So it'll be interesting to see how that plays into it. I mean, they've done very well over the last year, so it doesn't seem to be hurting them. Maybe it could even help them a little bit. But there's a big shift going on in the Australian government where we're moving away from all the consultants we spent too much money on, as we talked about last week, all the problems with consultants. And it's interesting to see because
exceptions to the rule, Mike Brizzy. Exceptions to the rule.
We're trying to quickly hire for, I don't know. It feels like that's going to be pretty risky as well. Like just hiring a lot of salaried people to do the job. And it's like, do you get the best people? Like what's the incentive for the best, business person to go work in government? Because that's what the government's trying to do is pick winners, right? Like let's have a good understanding of quantum. And it's like, all right, not many business leaders have, like almost nobody has a good experience.
That in a nutshell is the problem with government, right? It's just like the idea that if I throw money at something, I'll fix a problem. Money is needed, no questions, but that's it's sort of, oh my gosh.
Better focus on shaping the playing field. But sorry, Claude.
I'm massively against them doing this quantum computing investing thing. Like that's just so bad.
So dumb.
It's so irresponsible. Like you just know that's some kind of that's Labour that's the Labour government or some just
they're
one
both
of
as
the
bad
worst
as each
things.
other.
Just
Yeah.
fucking, just they've got their own interests there. I've no idea why they're doing that. But yeah, more to the point though, with TechnologyOne, the only thing that I guess I'd note is that it makes sense for a government-focused company to have weaker cash flow in the quarter that doesn't include the quarter to June. So they said that even though their cash flow was weak in this half, they're expecting it to bounce back for the full year. So that's like one thing historically that I didn't like so much about TechnologyOne is they do have a lot of money running out through the capex line there, and you just wonder how much they can go keep going with that. But overall it's still good, and I agree with what you guys say. Obviously I would expect the cash flow to come in the second half. I don't think a company's bad because cash flow looks bad on the traditional half. It does. Data3, which I own shares in, has a similar kind of profile there. So yeah, overall I kind of agree with what you guys said. I do think that you can probably like hold this, or like I'm interested in this stock because I think it's like a resilient earner. I think it benefits from the general halo effect that like stable growing companies get, considered like a quality growth stock. I think as money chases like growth, then it tends to benefit. And in the long term, I think that these kind of businesses end up getting disproportionate share of of good sticky superannuation money, because the people with growth options in their super funds are usually younger people who are going to be sticking with the stock for longer. So once they get to a certain size, as TechnologyOne is, they're part of a fairly small pool of viable sort of growth stock investments for the super funds to make, and they've got money to deploy every month or however often. So yeah, like I think that there's a sort of sociological element that keeps the PE ratio of these kind of businesses quite high. TechnologyOne has a PE ratio of 50. I don't own it myself though, but I just definitely see like the argument for it there. It does remind me of like, sorry, this is not necessarily the best form of analysis or even necessarily valid analysis, but to me, Objective Corp, which I do own shares in, is like in a similar space business and probably like more attractively priced, albeit not growing as fast as it appears TechnologyOne is.
Another high quality business. Yeah, I'll just say so in 2017. TechOne was at a PE of 40, right? Since then, they've grown their earnings 50% in gross terms, and the share price is 3x. It's so yes, they grew very well in terms of profit, and then there was some PE expansion, but it's just, again, I'm saying the same back at that point in time. It's like, what a great business, too expensive, and I don't know. I do sometimes wonder, am I learning the wrong lesson? Am I looking at recent, quote unquote recent, which is sort of a multi-year period, and going, yep, the lesson here is just don't worry too much about valuation for super high quality companies. And then, yes, okay, finally I've learned that lesson. And I ape into all this really high, like brilliant businesses, but at silly prices, just as the market decides to, wait a second, valuation matters. And I don't know.
And then
messes with your head.
That's what we just had. Like, we're bounced out of that now, but the valuation matters moment we had like in 2022 2023, like
the small caps particularly.
We're still in it for small caps. So that's the thing. It's like,
yeah.
I think what I'm going to, like, I already said it, but like I do definitely think that if the bull market continues on these like larger growth stocks, like eventually that, like if that's sustained long enough, it does start flowing down generally to smaller end of things. So like, but just because the valuation differential between small and big becomes so big, like so large. But already, I feel like probably the worst missed opportunities I had this year was just to like relentlessly play the like kind of index inclusion angle. Like I feel like I kind of missed that thesis on Macquarie Telecom, which has had like a good 25-30% re-rate as the founders have sold down shares, made it more liquid. They've done like capital raises, like et cetera, et cetera. It's just growing into the index like through dilution or increasing free float. And now there's a bit of a lather over it, and I think I did get some of that upside from Data3 at least. But I feel like that was like a huge layup that was happening. And I think maybe that's still happening, because when you've got the valuation differentials between the really big ASX 200 growth stocks and the ones and the rest gets too big, then it tends to pull up, just through natural equalizing mechanisms, pull up some of those smaller ones, especially if they look like they're on the verge of graduating into the big leagues. So don't think that's necessarily efficient markets at play markets just reach their equilibrium. You can influence that, and it's not always set in a way that totally makes sense based on the discounted value of future cash flows.
Yeah, I think it's really interesting, Andrew. We've kind of been, as Claude said, I don't know, it feels like we're back into a bit of FOMO again as well. Like the market's in that moment where it's like, ignore valuation.
It's, GameStop and AMC are pumping.
Yeah.
And who knows, like, will it be shorter or longer or the same? Like, sometimes this, like, the joie de vivre takes hold, and then that sucks more people into the market, and it can run for a while.
I sure can.
All right, should we wrap it there, gents? Anything else you guys want to?
I can remember old podcasts back, like, in 2018 when we were just, like, laughing and joking about, like, Pro Medicus being $15 and being like, the FOMO, blah, 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 if you remember that.
I remember $50 going, woo,
Yeah,
oh my God.
So that stuff can run for a long time. So, sometimes the FOMO's right, I guess.
No, I was just going to say, thanks everyone for listening.
Yep.
I know you guys, I'm not doing anything. I'm still be here, but no one wants a 1 hour monologue each week. So look forward to catching up when you guys get back. And let's hope that the market, the baby giants have grown up a little bit in your absence.
Sounds good.
Excellent. I'll check in my gratitude, which is thanks for listening, everybody. It's like really great to, share our chats with you and get all the feedback that we do and stuff. So, thanks for being such like a positive and encouraging bunch of listeners, and thanks for your time, and I hope you go well.
Yeah, all 4 of you. Thank you.
All our mums and one other person. All right. Thanks very much. Thanks, everyone.
See you guys. Bye.